Patrick Combs opens the envelope. It's junk mail. The kind that clutters mailboxes with fake checks designed to look real enough to grab attention, but harmless enough to avoid fraud charges. Bold red letters. Official bank design. A number, $95,789. Except this one is missing something. The fine print that says, not a real check. Patrick is 28. Unemployed. $300 in his account. And he's staring at a piece of paper that might be a mistake, or might be a test. He decides to find out. He walks to the ATM. He deposits it. The machine accepts it. 3 days later, the money appears. All of it. $95,789. Real. Spendable. Wrong. For 10 days, Patrick Combs lives in a universe where a single processing error rewrites identity. Where numbers on a screen become more real than the paper they came from. Where being right and being legal are two different things. This is the story of the bank error that created a millionaire overnight. And the hidden cost of being technically correct. Let's back up. In the mid-90s, direct mail marketing hits a saturation point. Credit card companies, loan agencies, sweepstakes operations. They all compete for attention. The tactic: make the envelope look urgent. Official. The check design is key. It needs to look real enough to stop you from throwing it away, but fake enough to avoid breaking counterfeiting laws. The legal trick is the disclaimer. Usually printed in microtext along the border or on the back. This is not a negotiable instrument. Specimen only. Void if deposited. Patrick's check doesn't have one. Whether it was printed in error or intentionally left off to skirt regulations, no one will say. But the result is the same. A piece of paper that walks the line between advertisement and instrument. Here's what matters. Modern banking in 1995 is split. Physical branches still process paper. But the back end, the verification systems, the ledger updates, those are digital. And when a check enters that hybrid system, the question isn't, is this real? The question is, does this clear? Magnetic ink character recognition. MICR. The strip of numbers at the bottom of every check. Routing number. Account number. Check number. If the ink is correct, if the format matches, if the encoding reads properly, the system assumes legitimacy. Patrick's junk mail check has real MICR ink. It has a real routing number, tied to a Real Bank, First National Bank of Orland Park, Illinois. The account number? Also real. Belongs to the marketing company that sent it. The ATM doesn't read disclaimers. It reads magnetic signatures. And this one passes. April 1995. Patrick deposits the check at a Wells Fargo ATM in San Francisco. Standard procedure. The machine scans it, logs the amount, sends it to processing. Within the bank system, the check becomes a data point. $95,789.17. Pending verification. Day 1. Nothing. Patrick's balance still shows $300. Day 2. Nothing. He starts to assume the system caught it. That somewhere, a human clerk looked at the oversized novelty design and flagged it. Case closed. Day 3. The money appears. Not as pending. Not as provisional. As available balance. $96,089. The system processed it as legitimate. A digital ledger entry that says Patrick Combs now has access to funds he never earned, never inherited, never stole. Except he did nothing illegal. He deposited a check. The bank accepted it. Under U.S. banking law, once a check clears, the funds belong to the account holder unless proven otherwise. So the question becomes, will the bank notice? Patrick doesn't touch the money. Not immediately. He's aware this is wrong. But he's also aware of something else. This is a test of the system. If a fake check can clear, if the machinery of modern finance can mistake advertising for currency, what does that say about the entire structure? He starts documenting. Takes screenshots of his account balance. Prints transaction records. Writes down every detail. Because he knows, eventually, someone will come looking. Days 4 through 7. Nothing happens. The money sits there. Accessible. Real in every technical sense. Patrick could walk into a branch, request a cashier's check, transfer it to another account, withdraw it in cash. Legally, he could argue he acted in good faith. Deposited a check. Bank accepted it. Funds cleared. But he doesn't. Because he understands the difference between legal and right. And because he's curious. How long will it take? Day 8. Still nothing. Day 9. Patrick talks to a friend who's a lawyer. The advice is simple. Don't touch it. Document everything. Wait for the bank to notice. If they reverse it quietly, no harm. If they escalate, you have proof you never tried to spend it. Day 10. Someone at Wells Fargo finally reviews the transaction and realizes what happened. Here's the hidden mechanism. When you deposit a check, the bank doesn't immediately verify funds in the originating account. Instead, it processes the check through the Federal Reserve's clearing system. The routing number tells the system which bank to contact. That bank confirms, yes, this account exists. Yes, the MICR data is valid. But here's the gap. The system doesn't ask, is this a promotional item? It doesn't scan for intent. It scans for format. And Patrick's check had perfect format. The marketing company's account at First National Bank of Orland Park had money in it. Not $95,000, but enough to pass an initial balance check. The system assumed legitimate payee, legitimate instrument, legitimate transaction. This is fractional reserve banking meeting automated processing. Banks don't keep every deposited dollar in a vault. They keep a fraction, usually 10%, and lend out the rest. The system works because not everyone withdraws at once. But it also means the digital ledger, the number on your screen, represents a claim on money, not the money itself. When Patrick's check cleared, Wells Fargo didn't transfer physical cash. They updated a database entry. $95,000 became available because the system believed it existed somewhere in the chain. First National confirmed the account was real. The Federal Reserve processed the routing. Wells Fargo credited Patrick's account. 3 institutions, all trusting the format, none verifying the substance. The misconception most people have: if the bank gives you money by mistake, you can keep it. Wrong. U.S. law is clear. Unjust enrichment. If you receive funds in error and you know it's an error, keeping them is theft, even if the bank made the mistake. But if you don't spend them, if you simply let them sit while waiting for correction, that's a gray zone. And Patrick was betting on that gray zone. May 1st, 1995. Patrick gets a call from Wells Fargo. Not from customer service. From their legal department. The conversation is short. We need to discuss your recent deposit. Patrick plays it straight. Says he deposited a check he received in the mail. Says he didn't withdraw anything. Says he's been waiting for them to notice. The bank's response: they want the money back. Immediately. Patrick's response: it's your mistake. You processed it. You cleared it. If you want it back, show me the legal basis. This is where it gets complicated. Because technically, Patrick is right. The bank made the error. He didn't forge anything. He didn't alter the check. He didn't lie on a deposit slip. He simply tested whether the system would catch an obvious fake. And it didn't. The bank threatens legal action. Fraud. Theft. Criminal charges. Patrick hires a lawyer. The lawyer reviews the case and points out 3 things. 1. Patrick never moved the money. 2. He never spent $1. 3. He never claimed it was his. He simply left it there, waiting for them to fix their own error. Wells Fargo's legal team realizes they have a problem. If they sue Patrick, they admit their processing system failed catastrophically. They admit that for 10 days, anyone could have deposited a novelty check and accessed nearly 6 figures. That's a public relations nightmare. That's a regulatory audit. That's a security failure they don't want on record. But Patrick's lawyer also points out something else. If Wells Fargo presses charges, they have to prove intent to defraud. Patrick's documentation proves the opposite. He didn't hide the money. He didn't create shell accounts. He left it in plain sight. He even called customer service on day 6 to ask if there were any issues with his account. The representative said no. Wells Fargo is stuck. They can't sue without exposing their own failure. They can't press criminal charges without proving intent they can't establish. So they pivot. They send a letter demanding return of the funds under the Uniform Commercial Code, which governs negotiable instruments. They cite Section 3418. A check drawn on insufficient funds is not a valid instrument, and any payment made on it can be reversed. Patrick's lawyer counters. The check wasn't drawn on insufficient funds. It was drawn on a real account with real money. The problem wasn't the account. It was the intent of the check. And intent, under banking law, is determined by the issuer, not the recipient. Patrick didn't issue the check. He received it. Wells Fargo processed it. The mistake is theirs. 3 weeks of letters. Threats of litigation from both sides. Wells Fargo brings in outside counsel. Patrick's legal bills start mounting. Finally, a settlement. Patrick returns the money. Wells Fargo doesn't press charges, doesn't report him to credit agencies, doesn't flag his account. They bury the mistake. Patrick agrees. The money disappears from his account. The ledger corrects itself. Officially, nothing happened. Except Patrick kept everything. Every screenshot, every letter, every transaction record. And a few years later, he goes public. 2008. Westpac Bank, Australia. Christine Lee checks her account balance online. She's expecting around $5,000. The screen shows 4.6 million. She refreshes the page. Same number. She logs out, logs back in. Still 4.6 million. She doesn't deposit a fake check. She doesn't transfer money from another account. She doesn't do anything. The bank system simply breaks. Here's what happened. Westpac is running a routine database update. Account balances are being migrated to a new server infrastructure. Christine's account is flagged for a small overdraft correction. Negative $47. The system is supposed to credit her account with $47 to bring her balance to zero, then apply a small fee. But during the migration, a decimal point shifts. The correction amount, stored in cents, gets read as dollars. 47 becomes 4,700. Then, a second error, the system misreads the account type. Instead of applying the correction to her checking account, it applies to her savings account, which has a $5,000 balance. The addition processes 5,000 plus 4,700. Then, a third error, a multiplier script designed to convert foreign currency deposits, misfires. It's supposed to apply only to international transfers. But the flagging system is down for maintenance. Christine's account gets processed as if it received a deposit in Japanese yen. The multiplier for yen to Australian dollars at the time, roughly 100 to 1. 5,000 becomes 500,000. Then, through a cascade of identical errors across multiple check processes, it compounds. For 0.6 million, the kind of error that should trigger automatic alerts. But the alert system is also down for maintenance. The fraud detection algorithm that should flag any balance change over $50,000? Offline. The manual review queue that should catch anomalies? Backed up for 72 hours due to the server migration. For 3 days, Christine Lee is technically a multimillionaire. She doesn't withdraw the money. She doesn't transfer it. She calls the bank. Twice. Both times, she's told her account is fine. The customer service representatives don't see the error. They're looking at cache data, not the live ledger. The system hasn't synced yet. Day 3, an internal auditor, running a routine check on high balance accounts, notices the discrepancy. 4.6 million in an account that, 3 days earlier, had 5,000. No corresponding deposit record. No transfer log. Just a balance change with no source. Westpac reverses the credit. No charges filed. No public statement. Christine is told it was a technical error, and her account is now correct. She asks for documentation. Westpac provides a single-page letter confirming the correction. No explanation of how it happened. No apology. Just a correction. But 6 months later, Christine tries to apply for a car loan. Denied. She checks her credit report. Nothing wrong. She calls the bank. They tell her she's been flagged in their internal fraud monitoring system. Not as someone who committed fraud. As someone associated with a high-risk account anomaly. The flag is automated. No human reviewed it. And it can't be removed without a manual override, which requires managerial approval. Christine fights it. Writes letters. Escalates through customer service. Finally, 8 months after the initial error, a manager reviews her case and removes the flag. But the damage is done. She missed the loan window. The car she wanted to buy was sold. The interest rate she qualified for expired. Same mechanism as Patrick's case. Different trigger. The pattern: digital banking systems update faster than verification protocols. When the gap opens, money exists in a state between real and imaginary. And the people caught in that gap become test cases for how the system responds to its own failures. Here's the one detail that changes everything. The MICR ink. That magnetic strip at the bottom of checks. It's printed with iron oxide particles suspended in a resin base. Specific density, 14 to 16 milligrams per square inch. Specific spacing, 13 characters per inch. Encoded in the E13B font standard. Designed to be read by magnetic scanners, not human eyes. When the technology was developed in the 1950s by the Stanford Research Institute and General Electric, it was revolutionary. Automated check processing, faster transactions, less human error. Banks could process thousands of checks per hour instead of dozens. The cost savings were enormous, but it created a new vulnerability. If the ink is correct, if the encoding matches, if the spacing is accurate, the system trusts the check. It doesn't matter if the paper is oversized, if the design is absurd, if the amount is implausible, if the check is printed on cardboard. The machine reads the magnetic signature. And if that signature matches the expected format, the check is treated as valid until a human reviews it. Patrick's junk mail check had professional-grade MICR ink. Either the marketing company paid for legitimate encoding, or they used a printer capable of producing it. That single detail, that strip of magnetic particles, convinced the entire banking system that a promotional gimmick was a legal financial instrument. And here's what most people don't know. MICR ink is not restricted. You can buy it online. Toner cartridges with iron oxide, MICR-compatible printers, E13B font software. All legal, all available. Because the system assumes that having the right ink doesn't mean you'll use it fraudulently. The security isn't in the ink. It's in the verification that happens after the ink is read. Human review, balance confirmation, fraud detection algorithms. But when those systems are down, when the verification queue is backed up, when speed is prioritized over accuracy, the ink becomes the only checkpoint. And that checkpoint is bypassable with $70 of equipment and basic graphic design skills. 2008. TD Bank, Pennsylvania. A man we'll call Michael Chun receives a bank statement. His account balance, negative $800. But when he checks online, it shows positive $12,000. He calls the bank. They tell him the online portal is experiencing technical difficulties. They assure him his actual balance is negative $800. He should disregard the online display. Michael hangs up. But the next day, his debit card works. He buys gas. $40. Transaction approved. He checks online. Balance, $11,960. He tests it again. Buys groceries. $80. Approved. Balance, $11,880. The system is letting him spend money that doesn't exist. Not because he deposited a fake check. Not because of a database migration. Because TD Bank's fraud detection system flagged his account for suspicious activity, froze it, but failed to sync the freeze across all platforms. The branch system shows frozen. The online portal shows active. The debit card network shows active. 3 separate systems, 3 separate statuses. Michael spends $3,000 over 2 weeks. Car repair, rent, medical bills, all approved, all processed. Then, without warning, his account is locked. TD Bank reverses every transaction from the past 14 days, charges him overdraft fees for each one. His account balance, negative $4,200. He didn't know the money wasn't real. He called the bank. They told him it was a display error. He assumed, when the card worked, that they'd corrected it. But TD Bank's position, he should have known. The statement said negative $800. The online balance was wrong. His responsibility, to verify. Michael hires a lawyer. The lawyer argues, Michael acted in good faith. He reported the discrepancy. The bank told him to ignore the online portal, but the bank's own systems approved every transaction. How is a customer supposed to know which system is correct? TD Bank settles. They reverse the overdraft fees. They credit his account back to negative $800. They don't refund the $3,000 he spent. They call it a courtesy adjustment. Michael agrees because fighting it would cost more in legal fees than he'd recover. 3 cases. 3 mechanisms. 1 pattern. When the digital ledger conflicts with physical reality, the system doesn't stop. It keeps processing. And the person caught in the gap pays the cost. Patrick Combs never spent the money. But the experience cost him. Weeks of legal stress. Threats of prosecution. The knowledge that even though he was technically right, the system could still destroy him if it wanted to. Christine Lee did nothing wrong. But her name ended up in Westpac's fraud monitoring database. Flagged as a potential risk. Not because she committed fraud. Because the system failed around her. Michael Chin tried to verify. Called the bank. Asked for clarification. And still ended up $4,000 in debt because 3 separate systems couldn't agree on a single number. This is the hidden cost of banking errors. The technical correction is easy. Reverse the transaction. Update the ledger. Move on. But the human cost? The anxiety of knowing a single database glitch can turn your life into a legal investigation? That doesn't reverse. And here's the deeper problem. These aren't isolated incidents. They're symptoms of a structural flaw. Modern banking operates on the assumption that digital records are accurate. That if the system says you have money, you have money. That if the system says a check is valid, it's valid. But that assumption breaks the moment the system makes a mistake. And systems make mistakes constantly. Decimal errors, encoding glitches, syncing failures, migration bugs. Every bank has them. Most get caught before they reach customers. But the ones that don't create these edge cases. People who technically have money they don't own. People who technically owe debts they didn't create. People who exist in a legal gray zone where being right doesn't matter because the institution has more resources, more lawyers, and more patience. 3 lessons from the accidental millionaire files. 1. System design creates incentives. When processing speed is prioritized over verification accuracy, errors become inevitable. The faster money moves, the wider the gap between digital record and physical reality. Banks could add more verification steps. Manual review. Secondary confirmation. Balance cross-checks. But every additional step slows down processing. And in a competitive market, speed wins. So the system optimizes for speed, and errors become an acceptable cost. 2. Legal gray zones are traps. Even when you're right, even when you haven't broken a law, the institution has more resources than you. They can afford to threaten. You can afford to fold. The law protects the system, not the individual caught in its failure. Patrick could have fought Wells Fargo in court. He probably would have won. But the cost of winning, the time, the legal fees, the stress, would have exceeded the value of being right. So he settled. Christine could have sued Westpac for the credit impact. She probably would have won. But the cost of litigation would have been more than the car loan was worth. So she waited. Michael could have taken TD Bank to trial. But the $3,000 at stake wasn't worth the risk of losing and owing even more. 3. Digital trust is fragile. We treat numbers on a screen as truth. We assume the bank's balance is correct, the ATM processed it properly, the transfer went through. But those numbers are just entries in a database. And databases make mistakes. The question isn't whether they'll make mistakes. It's what happens when the mistake is in your favor. Because in that moment, the burden of proof shifts. You have to prove you didn't know. You have to prove you acted in good faith. You have to prove you're not exploiting the error. And proving innocence is harder than proving guilt when the institution writing the rules is also the one judging the case. Patrick Combs eventually turned the experience into a one-man show. Man 1, Bank 0. He toured colleges and corporate events, telling the story as a cautionary tale about testing systems without understanding the consequences. The show ran for over a decade. He made more money performing the story than he ever accessed from the fake check. The check itself? He kept it, framed it, hangs in his office. A reminder that sometimes being technically correct is the most expensive kind of right. The marketing company that sent it, never publicly identified. No legal action was taken against them. The entire incident was treated as an anomaly. A fluke. A one-time failure that couldn't happen again. Except it did. Christine Lee, Michael Chun, and dozens of smaller cases that never made headlines. A woman in Ohio whose mortgage payment was processed twice, overdrafting her account, leading to a cascade of bounced checks and fees. A man in Florida whose direct deposit was credited to the wrong account, leaving him unable to pay rent, leading to eviction proceedings. A couple in Texas whose joint account was mistakenly closed during a system upgrade, freezing their access to funds for 3 weeks. Always the same pattern. Digital ledger updates faster than human oversight. Money appears, money disappears, and someone's life becomes a case study in system failure. The breach isn't in the code. It's in the assumption that code doesn't make mistakes, that numbers on a screen reflect reality, that the system, because it's automated, must be accurate. It's not. And when it breaks, the first casualty isn't the money. It's trust. That's the story history tried to hide. Next time, we open a file on something different. When the error isn't accidental. When someone inside the system decides to test how far a single keystroke can go. When the person with access realizes the same vulnerabilities that caught Patrick, Christine, and Michael can be triggered intentionally. If you want to see how deep these breaches really go, subscribe, because the files only get darker from here. I'll see you in the next file.